dinner party investments, not as good as ugly ones. Yield focus, not bragging rights.
So
That's such a mark, isn't it?
So lots of people love to sort of buy properties and then go and tell other people about what they bought, which is fine. But I generally say that the category of investors that make the least in this space are usually ones that go out and buy stuff because it looks good, and because less sophisticated sort of investors or people who haven't invested before are impressed because they bought a nice shiny sort of house or brand new flat or whatever, and because it says in the Daily Mail or some other newspaper that this is the latest investment and that's the hot spot and all this sort of stuff. Often it's not the case. Generally speaking, and this is a generalisation, the uglier the rental property, in sort of a couple of steps up just from the Bronx, is the best stuff to buy from a yield perspective. That's the amount of income that it generates as a percentage of its value, and I think it's very important to focus on that, and focus on the money, and the money will give you sort of bragging rights if that's what you need. But I've seen that so many times. People will go out and buy a big 5-bed house along a really nice street, and rent it out to a nice family, and they'll end up with a 3% yield, whereas they could have gone and bought 10 small single lets and got a 7% yield. The debt that they manage to borrow on the £1 million house, 5-bed, might be 400,000 because that's the biggest amount of money that rent will support, because the bank will work out, well, what's the monthly mortgage payment going to be? How much rent do we need to support that? Well, the rent's only this, so therefore you can only borrow 400,000. Whereas if you go and buy smaller, much higher yielding properties, well, they can support a much greater mortgage. So on those you may borrow 750,000. So
I guess as well, you're not tying it all into one property then. So you
yeah,
have more
it reduces the risk
well.
for sure. So you're putting 250,000 in the 10 small single lets versus 600,000 into the big one.
5-bed.
Yeah, and after all the costs, the 10 single lets will generate a bigger income. Capital growth, well, it may be about the same. I don't buy into the notion that small, lower end properties in cheaper areas go up less than nicer, bigger properties in more expensive areas. I think that is just a misconception and a fallacy. But I hear it all the time. Oh, there's more. You will always get more capital growth in the nice areas. And it's just bunkum. It's absolute bunkum, because if you look at it may be the case that at the start of the cycle, or at a given point in time, that the nicer area is rising, and after a recession, that they're typically the better areas are the ones that rise the quickest. But what you'll find is that at a different point in the cycle, the lower end area will be rising more than the nicer area, a little bit like now. So you had 2010, the epicenter of UK property would be Mayfair. That's where all the growth started, and you had Mayfair, Knightsbridge, Kensington, Chelsea, all the best areas, and they rose very strongly from 2010 onwards after the recession. And you saw areas of the north or Scotland even still going backwards. And of course, all I heard for many years was, your property in London is always going to go up more than your properties in the north, or properties in the Midlands, and that was true at the time. But people have short memories. We're now into a phase where those areas have actually fallen a bit, because stamp duty's gone up and because of the uncertainty around Brexit. But I think more so what the commentators don't mention is that those areas have had such a good run, and they're like at the front of the roller coaster, and they've gone up to the top, and they're coming down, whereas you've still got the sort of north of England and maybe definitely Scotland and the Midlands, which might be that's still going up to the top of the sort of hump on the roller coaster track. So you're seeing certainly outside of London, that is where most development funders are happier to lend now. Lots of the investors within London won't buy within London. They want to buy outside the M25 in areas like the Midlands or some areas of the north of England, commuter land. So I think it's important to understand that, and it's important to probably buy in those areas when they're feeling a bit unloved and people have turned against them because there might have been a great run in London for a period of time. But just remember that people and the economy and the environment is fickle, and that soon changes. Capital growth, you can't predict sort of exactly when it's going to take place and how much, but over the long run you can have a pretty good idea of what's going to happen.